What is $1 million baby or a trust fund baby? A lot of you may have heard these phrases. You don't know the difference, you don't know how they work, or how could you start something for your child? Well, I want to break that down for you guys here so you can learn the pros, the cons, the different strategies, how to be able to make sure that your children are good if it's for college, for vehicles, for education purposes, wedding purposes, retirement purposes, but you structure $1 million baby strategy correctly, you could have your kids by the time they're in their early to mid 50s tax-free millionaires. So, ladies and gents, just here to drop a few cents. You're here with Earl, the money coach, a decade licensed in the financial industry and 2 decades of investment portfolio experience. I want to break this down how you could use this correctly in this video. But before we get started, you know the drill. Make sure you like, follow, and subscribe, and click on the links in the description below where you can start your health savings account, get automatically approved for life insurances, and business owners, if you're looking for business funding, check out for the equity loans in here. So let's get started on the $1 million baby. What is $1 million baby strategy? How does it differ from certain things, especially when it comes to schooling? Because that's the big one. Most people want to set up stuff for their kids and they're thinking about either retirement or education. Now, education, you may have heard of a 529 college savings plan. Not a bad strategy, but it's focusing just for college. And then if you have something for your children, you're looking for more on a long term, kind of to get them to retirement, well, there's different strategies. You may not know what you want to do. You might want to do mutual funds or some kind of investment. Now these days with the cryptocurrencies, if you want to have something that's more on the insurance side, getting annuities, you're funding stuff for your kids, putting it in a trust, you don't know what to do. So let's break that down. But let's start with what a $1 million baby is. $1 million babies is a structured life insurance strategy that allows you to have tax-free growth. Okay, these are what you call tax advantage accounts, and they're in the codes right there. You have a section 7702, which allows you to understand how you could use these different plans and strategies, including with the IRC, the Internal Revenue Codes, 101A, TEFRA, and DEFRA laws, which allows your money to accumulate tax deferred. You could loan it to yourself tax free and have everything attached to your insurance strategies. That's what $1 million babies are. Now, you hear people talk about IULs, which is Index Universal Life Strategies. You hear people talking about whole life strategies, how to do it, how to have it structured for your kids. Everyone's needs are different. I'm not here to argue with folks. It's World War III already when it comes to what kind of insurance is best. Everyone has their own specific needs. I structure a lot of mine with IULs, with Index Universal Life for the children. Sometimes you could use whole life if the family has something that they're specifically looking for. Now, why are $1 million babies so powerful? Because when you have an Index Universal Life Insurance, the U is universal, meaning it could be used universally. That is huge. Most things are tied to a specific thing, like a 401k tied to retirement. 529 college savings plan is tied to college, but you're not locking something in once you have it in your insurance that can be used universally. So I personally have set up for people for their kids where they're 15 days old, because that's the limit. You have to be at least 15 days old as a child, but we're setting it up. So by the time they turn 18, they have $25,000, $30,000 tax free for their college. After they're done with college, they use the same account to be able to help purchase that vehicle. 8, 9 years down the road, if they want to get married, guess what? They use those accounts to help themselves help the kids get married. If they're looking to get a house, you need a down payment, you could withdraw from these kind of accounts. For your retirements, tax free, you could take out a certain amount and you could pretty much ride off in the sunset. You could use all these different strategies when it comes to a college savings, not a college savings plan, a IUL, instead of a college savings plan. Now, your 529 college savings plan, a lot of us have heard about it. It's not a bad strategy, but one of the cons are it's specifically for college. If your child says, hey, mom, hey, dad, look, I don't feel like going to college. I don't want to go to college. Well, to withdraw those funds from your 529 college savings plan, you're going to get penalized, generally speaking, 10%. So if the kids don't go to college, you're kind of SOL. But thankfully, there are certain ways you could do stuff. Now they're talking about last year, 2024, how you could roll it over into certain specific kind of IRAs. So there's a lot of different ways that could be done, but you want to make sure you understand how it works. Now, why do I say this? A great strategy, that 529 college savings plan, but you're locking yourself in with these IULs. If you want to have it, like I said, for specifically different needs, specifically different purposes, you could withdraw that money because there's no time limit to have withdrawals from your IULs, your index universal life, and your whole life strategies. It's called cash value accumulation. When the money inside of your life insurance starts to accumulate, that cash value, there's not a time limit on when you need to take that money out. Like a 401k, your 401ks, your IRAs, some of your annuities, you got to wait to 59 and a half. So what if you're 35? What if you're 45? What are you going to do? Well, these strategies with your IULs, thankfully, you're not locked into when you have to withdraw those funds, as long as it's cash value. But there is a loan provision. Understand, anytime you have life insurances, if you want to take that money out and loan it to yourself, there is a loan provision, which pretty much you're paying a fee. Fancy way of saying a fee. You could sugarcoat it. Loan provision is a fee that could be anywhere from 2% up to 8-9%. I've seen from certain institutions and their life insurances. The good thing with some of your IULs and some of these strategies is that a lot of them may be 2.5 to 3% for those first 10 years, and then they give you a pretty much a credit back. So one of my favorites is at 2.25%, meaning that loan provision, if you touch your money in the first 10 years, it's a 2.25% fee to withdraw those funds and loan it to yourself. But after 10 years, they give you 2%, kind of like a wash loan. So it ends up only being 0.25%. So you want to understand how that works, because folks don't understand. You might not have taxes and taxation on your insurances, but there still is a cost of insurance, or if you want to move it out. A lot of folks and a lot of insurance agents, they don't tell you guys that. So I want to make sure you guys understand how that works. Now, why is this such a great strategy? I don't want to go off topic, but it's a great strategy because most people don't have something they could use for their children to create generational wealth. Because not only do you have generational wealth being accumulated, right, to use however you want, you still have the life insurance attached to it on the back end. So now your grandkids, as they get older, guess what? Your kids get older, they start having children. Anything happens to them, guess what? It has a beneficiary attached to it. And we're talking very subtle, very simple. You don't have to have, something dramatic. My last client, we set up $250,000 as the face amount for their child. And that $250,000 was costing $46 a month. So we're talking anytime from $40 to $50, maybe $60 a month that you could have that you're putting to your children. We're talking $500 to $700 a year. Some of you folks, you're getting $1,500, $1,600 back on your taxes. What I regularly advise, right now is April, so we just kind of finished up the taxation season. In the tax season, guess what? Well, when you get your money back from your kids, you get 1,500 back from your children. Put 500, put 600 back into your kids. Invest back into them. So by the time they're hitting college, you got $18,000, $20,000 tax free. Now, obviously, you want to push them, make sure that they get that college degree, and make sure that they get that scholarship. But if they don't get a scholarship and all that kind of stuff, you have a plan that could work. So I always talk about this. It's something a lot of folks don't talk about because they don't really understand. I want to break down some statistics right here. So your 529, I'm gonna start with that first. The total assets in the 529 plans is 508 billion, meaning a lot of people got them. So I'm not bashing or bad knocking 529 college savings plans. Just understand, if you're watching this video, you could be saving for 14, 15, 16 years. If your kid say, I don't want to go to school, now you're going to have a penalty just to withdraw those funds. Now 35% of families use college savings funds, averaging about $6,844. That's huge. So 35% of families are using it, but 51% of Americans are unaware of 529 college savings plans. So a lot of people don't even know what could be done for their kids when it comes to saving for college. That's what we're talking about. 529 $1 million baby insurance strategies. Most people don't even know they're aware. So we want to bring that awareness to your guys. Now, why is this important? Average college cost right now in 2025, public in-state, is $29,910 a year, which ends up being $119,640 total for 4 years. That's public and in state. Now, public out of state is $49,080 a year, which ends up being $196,320 total as of right now in 2025. Now, private nonprofit, we're looking at $62,990 a year, which roughly is about $251,960 in total. So you're seeing that's a whole bunch. So, and that's including tuition. So we're including tuition, room and board with a lot of that stuff. But even without that, it's still a whole bunch that folks are spending. So you want people to understand that. Now, I also said your $1 million baby strategies could be used for cars. If you want to get something for your children down the road, maybe get different vehicles. The average they're saying, looking at the stats, parents typically spend between $9,000 and $20,000 when it comes to a first vehicle for their children. From $9,000 to $20,000 is the average range. So now we're talking, if you're trying to help your children out, you're spending, let's just say 15,000 on a vehicle, you're spending 29,000 a year on college. That's a lot of funds, man. That's a lot. So if you don't have something in place like your $1 million baby strategies, how much are you going out of pocket? If you want to pay for your child's wedding, the average United States wedding cost is about $33,000. But here's the thing, parents cover about 52% of total wedding costs. $17,160 is the average contribution. The bride's parents generally spend $12,000 and the groom's parents generally spend $7,000. So we're talking a lot of funds if you're trying to help your children and set them up correctly in life. That's where your $1 million babies and trust fund babies come into play. You know, we're not even talking about homes. We're talking 20% for home buyers. That's about 39,000 on average. So, folks, the reason I'm saying all these statistics is because you want to set everything up for your children. So it's not just a one hit, you know, just for college, just for retirement. Your baby strategies, your $1 million baby strategies gives you something where you could plan out accordingly for multiple events for your kids. Now, here's some of the great news when it comes to these $1 million baby strategies are it's going to be on the child and you are going to be the owner. So you say, you know, your child, you know, your son or your daughter, you get a life insurance strategy on them. They're the actual person on the life insurance strategy. You are the owner and you are the payer. So you're the owner, you're paying for everything. Now you can switch it over to you. Look, when your kids turn 18, they get out the house, bam. Well, this is on you, son. This is on you, daughter, or at whatever age. But a good thing about a lot of these strategies, if you have them structured correctly, if you're overfunding from the start, you could pay into these accounts and then, you know, after 10 years or so, it's good to go. Let it sit on autopilot. Now, what do I mean about overfunding? I want to kind of dive into the insurance side and then I'm going to get into the trust side of everything. Now, the insurances, you have to make sure that they are properly structured. I can't tell you folks how many times I'm sitting down with clients who have life insurance agents who screwed them over. And how did they screw them over? They didn't tell them how these things properly work. Term life insurance is something very simple. $35 a month, boom, have at it. Whole life, you're spending $200 a month, have at it, you're good to go. Your IULs, your index universal life strategies, which is what most folks use for $1 million babies, that has a floor and a cap on how much you can make, and there's a floor and a cap of how much you could put into your account. The floor or the minimum, we call that the target premium, and then the maximum is the guideline annual. So let's just say your minimum is $100 a month, the max you could put in is $1,000 a month. Well, guess what, folks? When you see these strategies, if your life insurance agents just set you up on that $100 a month, and that's all you're doing, just month after month after month, bam, bam, you're putting $100 in a month. By the time your 2-year-old's 18, you're not going to see that money that you're expecting. These accounts are designed to be overfund. They're designed to be maxed out so you can have the maximum amount of money going in that's using compound interest and growing for you. If you're not overfunding these kind of accounts, you're pretty much, I always tell people you're buying a super expensive term in a sense because you're not using it the way it's supposed to be structured. These accounts are designed with your IULs and $1 million babies to be max funding, overfunding it, putting in as much as possible, letting that money accumulate. Like I said, you got those taxes. And your IRCs, you got the 7702, you got the 101A, your DEFRA law, all these things that allows your money to accumulate tax free, which is great. But if you're not utilizing how much you're putting in, you're holding so much more than what it could be done. You're holding that back from your, not just your children, but on how it's structured. So you want to make sure that you're maxing these strategies out, because if you're not maxing them, you're not getting those returns. Now, talking about returns, a lot of companies are different. If you look at a rolling 20-year average, most companies are anywhere between 6.5 up to 9.5% on a rolling 20-year average. That's including 2008. That's including what just happened earlier this year, what happened from COVID hit. So you have a lot of dips and losses, and it's still averaging these kind of numbers. Now, certain companies, different strategies, you could change the strategies within these different insurances. Where I have some of my clients, they've been averaging 14, 15%. You could have breakout years. You know, one of my companies that I work with, last year they gave 27% out to the clients. So that's huge. So you could have them structured different ways. Can you get ultimate and awesome returns? Yes. Generally speaking, between 6.5 to 9.5 is what you can see, but that money is growing tax free. You're not worried about anything. That's number one. Number two, it's a index. IUL's Index Universal Life means it's an index account which has a floor and a cap on the production on it. Meaning, if the market were to crash, generally speaking, the floor is zero. Zero is your hero. The market goes down 20%, you're locked in, you haven't lost a dime, right? Especially look what just happened in March and April 2025, and the market was just taking hits. You didn't lose any money in your index accounts. Now, there also was a cap, meaning it could be companies are different. You know, you have 11%, 13%, 15. I have some companies that have a cap at 20%. So let's just keep it at 15. Let's say if your cap at 15% with your life insurance, if the stock market went up 22% this year, the cap is 15. That's the most you're going to get. So there are going to be cons when you have these kind of strategies, but you're not losing anything. I tell people it's not about how much money you make, it's about how much money you keep. And that's what's super important when you have these $1 million baby strategies, because you know you're looking at it long term, a long term saving strategy. And you heard what I said, saving strategy. Understand life insurances are not investments. Any life insurance agent that says this is an investment, they're full of crap. It is not an investment, it's a saving strategy. Why? Because it's reflected on what the market makes. So, folks, that's huge to understand. You want to make sure you have these things really working for you. That way, you're not having to worry about anything that could really hurt you on the back end. So, with that being said, let's kind of transition over to when you talk about trust fund babies. What do you do? How you set all this stuff up? Now, understand having a trust setup is key. Different trusts, multiple trusts out there. There's some companies that I work with that actually do have some great trust out there, but you generally speaking need to have a attorney to be able to set up a trust. But once you have a trust set up, you could have your insurances and everything go within that trust. So folks, that's huge. The reason why it's huge is because you could set up parameters on what your child is doing. Meaning, look, you have $100,000 of cash value. Once you hit 18, you're only going to be able to access say 25,000. And then once you hit 21, you could access a little bit more. You could structure the trust on how you want to have it with the specific instructions, directions, parameters, all that kind of stuff you could have to kind of make sure everything's good to go. But I tell folks, open up a trust, have your insurances, have all your investments, everything inside the trust, and make the trust a partial beneficiary. That's why these $1 million baby strategies are so powerful, because people are setting them up. They have it. The trust could be paying it. You know, all that kind of stuff, or they could have a look. You're going to have two beneficiaries. The main primary beneficiary is going to be whoever you decide. Say 80%, 85%, and the other 15% goes back into the trust. So the next time someone in your family has a child, guess what? 15 days in, trust automatically picks everything up, and you're setting up something so you could keep generational wealth going in. So folks, that's my time. I want to break down the power of having $1 million babies and using IULs. If you know how to use it correctly, it could be a great tool. If it's properly structured, you understand how you can loan everything to yourself, and you sit down consistently with a life insurance agent that knows what they're doing and can set that up. one of my specialties. Click in the link in the description. You can schedule a consultation with me if you want a little bit more. But that's it, ladies and gents. Make sure you like, follow, and subscribe, and check the description below to give you guys incredible tips on what really can be done for yourself financially. And I'll see you on the next video.